Welcome everybody to a Friday Fireside Chat. A couple of reminders that we are recording this, so don't say anything that you don't want your mother or the New York Times to find out about. And these replays will be available on YouTube in 4 or 5 days, something like that. We do take questions in the chat. We'll get to them if we have time, and if we don't, we'll follow up with you after the session. So, welcome everyone. So my guest this week is Zachary Karabell. He's a prolific author. His new book is called Inside Money, Brown Brothers Harriman, and the American Way of Power. It's pretty comprehensive, as you can gather. But he's had a bunch of other books. I think this is book number 12 or something. One of your earlier ones I got was Leading Indicators, how the numbers that we use for economics are no longer fit for purpose. And we maybe want to get into that a little bit at some point too. So you're also a fellow at the Foundation for Research on Equal Opportunity, part of the Progress Network at the New America Foundation, and as I mentioned, prolific author, writer. I don't know how you have time to do all that stuff. But, so anyway, welcome.
Thanks, Rita.
So Zachary and I first met, and I think this is supremely ironic given your recent book. We met at a place called Arden House, which is up in Harriman, New York, exactly. When you were attending a course that I was running at one point. And that was back in the day. It was a while ago.
It was 2003, 4, something like that.
Wow. So tell us a little bit about your journey. How did you get to be, where you are? Because you've done so many things. You've authored for famous journals, you've written books, you've been a commentator, you've started this foundation.
As I've said, I find those questions much harder than, who are we? What's the nature of capitalism going forward? What's American power going to be? Those questions of like, how did you become yourself strike me as infinitely more complicated.
Oh, sorry. Well, you can only tell the bits that are important to you.
I was an academic. I decided I didn't want to be an academic. I got a PhD. I knew that I wanted to write books, and I was an author in the late 90s in New York during kind of the first internet bubble craze. I started doing a lot of day trading because I was bored and everybody was day trading. That was the time when the joke was you'd go into a taxi and you'd have a running conversation with your taxi driver. This is pre-Uber, about what Yahoo's stock was trading at post-IPO. And
it's always a danger sign, right?
Always a danger sign. Although, in the greater scheme of things, the bubble was a bubble, but the transformation of the economy into a digital economy was real. So, it wasn't all nothing. And I was antsy, and I didn't really want to be a full-time writer just because it wasn't enough for me, energetically. I'm also more of I wanted to be more engaged, right? When you're writing, this. When you write a book, you are always basically taking a step out and observing. And there's a difference between ideas and action. They're both crucial and they're both essential and they both make the world go round. But I kind of wanted to be a little more not just talking the talk, but also walking a walk. And it was somewhat between going into an internet company and going into the finance world. And because of 9/11 and my girlfriend at the time, who then became my wife, whose father had a financial firm in the World Trade Center, and everybody died, and he called me up and said, you got to come work for my company. So I did, because I would have if it had been a tire manufacturer in Passaic. And so some combination of nepotism, tragedy, and skill, I ended up in that financial world. And I had two conditions at the time. I said, look, I will do this. I obviously want to do this. I didn't really know him at the time, but I'm not going to stop writing books, and I'm not going to take out my earring. And he's like, fine, the books, as long as they don't get in the way of work. And I said, look, I'm not golfing on Saturdays, and I stay up late at night. So I kept writing books. Mm-hmm. He said, I'll get back to you about the earring. And then he said, no, it's great. It'll appeal to like the young demographic. You can be on TV. We can be like the hip money management firm. So I did that, and then I ran a hedge fund, and then I was the head of strategy for a pretty considerably large financial technology company. And then I kept writing books. And this book is probably the closest integration, and a couple of others too, but this is in many ways an integration of my prior life as an American historian and academic and the 20 years I've had in the financial world. And it's a nice
synthesis
marriage. Yeah.
Mm-hmm. I can see that. So you had really unprecedented access to their archives, as I understand it.
Yeah, although to be fair, anyone could have unprecedented access, because they had 150th anniversary in 1968. Brown Brothers Harriman did, and as people probably don't know, because it was a household name and is now basically a vestigial memory of Wall Street. It still exists, but it's the oldest financial firm still in existence, which doesn't make it book worthy, right? A long life is not necessarily an interesting life, but in many ways, I think they had a very interesting life. In 1968, they put their founding at 1818, which I frankly disagree with, and that we don't have to get into that, but they commissioned a corporate history, as people are wont to do. And the gentleman who was commissioned took 4 years, gathered all of their archives in one place, and then at the end of it deposited those boxes, about 120. I don't remember the exact number because some of them are photographs, and 120 plus boxes are deposited at the New York Historical Society. So anyone can go and look at those. You don't need permission from the firm to access their historical record. And I don't write a whole lot about the contemporary firm, not because they're not viable and not because they're not ongoing, but they're not, part of the point of the book is they're not really a stunning story narratively in the past 30 years. And in many ways, that's a really good thing. Like part of my point about the book is, you want a whole bunch of firms doing good work, honorable work for reasonable prices, making money that aren't in the headlines. That like you want that as part of a system, and you want to know that that's part of a system, even if it's not something you're writing about in headlines. So I did have their cooperation, and I did have their goodwill, and I did want to assure them that what I was writing was going to be honest, right? I write about slavery, I write about their role in American imperialism, but by no means, I don't have an agenda of, oh my God, look at the evils of capitalism, or for that matter, an agenda of, oh my God, look at the virtues of capitalism. And they have a culture of, they don't want to be in the news. So the idea of writing the book initially for them was anxiety producing. They are the kind of culture that every day their name is not in the news is a good day. So the prospect of a book that would receive attention, and for better or worse, this book has received some attention, would made them nervous, right? And I did, I think, I respected that concern and kind of walked them through it, and because I do think it ultimately is a very positive book about their legacy, and I think they see that now.
Well, what a lot of people don't realize is just how much power that firm wielded at one point. The shape of our modern financial system, the infrastructure, the dollar. A lot happened in the nature of what they were doing that I think is understood. But I think one of the more interesting questions you do ask in the book is this question of what's enough.
Yeah. And there's been a kind of a minor through line since the 1970s of people questioning the more maximizing part of capitalism, as opposed to when is enough enough. Robert Skidelsky, who was the great grand biographer of Keynes, actually wrote a book with his son about 10 years ago called When is Enough Enough? It's people have been asking this question about particularly developed world capitalism for the past 50 years. So I'm by no means unique, or I think, particular in that question, but raising it through the lens of a financial firm partnership that still makes considerable amounts of money, just not crazy money. The firm today is about 5,000 people. They have about $2 billion in revenue, $500 to $700 million in profit, which is, a lot of money in human terms, but it's not crazy hedge fund money, and it's not Goldman Sachs money. And part of the question is, they are a firm in the past 30 years that was content to be what they are and didn't strive to be something that they're not. And there's a vignette at the very end of the book where they were doing a lot of business in the 1980s. They did it's a very wonky part of the financial industry where they were harmonizing foreign bought stocks in US dollars and clearing them for US mutual funds, right? Not really sexy stuff, but really essential if you're going to be a US investment firm buying foreign stocks. How do you price it that night? And they were getting all this business from huge clients, Lloyd's of London and Citibank and Goldman, because they were really good at this. And in the book, you'll understand why, because they had been part of the transatlantic commercial system since really that transatlantic commercial system got invented and evolved from 1800 between the US and the UK.
Mhm.
But they were getting too much business, more business than they were set up to handle.
Mm.
And one of the partners told me, look, the typical answer beginning in the 1980s, when deluged with clients wanting to hire you, would have been for the partners to have an emergency meeting, sit down and go, how many offices do we need to open? How many people do we need to hire? How do we need to scale up to match the business? And they said, we don't want to scale up to match the business. We want to be a partnership. We want to be private. We want to be the size that we are. And their question was, what business is appropriate for our size, not what size is appropriate for our business. And they fired their clients. They basically wrote them a letter and said, I'm sorry, you'll have to take your business elsewhere because we can't meet it. And we're not going to expand in order to meet it. And I thought that was a really telling anecdote, true story of a firm's culture that seemed so antithetical given what I know most companies and certainly what most financial firms do.
Mm-hmm. Yeah, absolutely. The culture really changed. And I thought it was interesting in the book that you pin the kind of moment we all became aware of this to the 1987 movie Wall Street.
Yeah.
And I remember I was in New York, in the 80s. And it was almost like you had this turning point of everything kind of changed. And, when I began teaching at Columbia in the 90s, and by then, there was this well-worn rut between Columbia and Wall Street. And that's what our students wanted to do. That's what caused the massive expansion of the MBA program in the 1980s. Everybody, get an MBA and get rich was kind of the model. But I think this underlying assumption that there's no such thing as enough is really, really interesting. It was John Bogle, who he has a story in the book, which is called Enough. And he recounts being invited to some fancy hedge fund manager's place in the Hamptons. And his companion said, how do you feel knowing that, you won't make in a year what this guy made yesterday? And Bogle's response was fascinating. He said, well, I have something he'll never have. And then his partner said, what's that? And he said, enough. Right. That's such an interesting mindset, though, because we and I go to these CEO things, right? And even at that level, even when like every minute you're making $1 million or whatever, the ones lower on the pecking order are jealous of the ones higher on the pecking order's corporate jet. And it's all a question of, let's keeping score, I guess. And
this has been going on for a while. So there's a story in the book about E.H. Harriman. So Edward Harriman, who, as you mentioned, his estate, Arden, on the Hudson was one of the largest private estates circa 1900. And the part that still exists and the Columbia for a while used as their executive education and offsite is a tiny portion of the actual estate. So he goes on a big expedition to Alaska because he's sort of a naturalist and that's his thing. And Harriman was one of the grand railroad barons of the end of the 19th, early 20th century, and for a brief period of time controlled, along with J.P. Morgan and James Hill, the Northern Securities Company, which was
Cassidy and the Sundance Kid. Remember that?
Cassidy and the Sundance Kid. I work for Mr. E.H. Harriman, Peacock. I'm forgetting the name of the guy in it, So the Brown Brothers Harriman, the Harriman part comes from the railroad empire of E.H. Harriman and his son, Averell Harriman. And they go on an expedition to Alaska, and he brings along John Muir because he can pay for the grandest, most famous naturalist of his day. And they would have these campfire debates, somewhat structured. And at that time, the Gospel of Wealth, which had been Andrew Carnegie's sort of later in life questioning of what's it all about, right? What's the money for? It was the beginning, really the progenitor of the giving pledge that Warren Buffett and Bill Gates, they should give away your money or at least portions of it in your lifetime, which of course Mackenzie Bezos is trying to actually live up to, and Lorraine Powell Jobs and a whole series of others. So this was kind of part of the patois 100 years ago in that first creation of absurd or massive wealth on the very, very top of the income spectrum. And at one point, John Muir says to E.H. Harriman, like what you just said, that Bogle said, I am richer than you, sir. And Harriman's like, what do you mean? And Muir says, I have enough. I'm content with what I have in the natural world. And you are always striving for more. And there is never more that's enough. And Harriman took umbrage to this and said, no, that's not true. And I'm not interested in money for money's sake. I'm interested in money for the effect that it can have on the human and the natural world, because they had this idea of like money could actually allow you to conserve nature. So it was a more complicated mix. But these, these debates within not just American, but a lot of other societies have been percolating, and they kind of, they wax and they wane, right? Mm-hmm. And we're in a waxing moment in 2020 about these things. I just think it's fascinating that we're not in a unique moment. Mm-mm. We're in the next turn of this particular wheel. And finally, and I don't want to keep rambling, the fascinating thing about the 1987 film Wall Street is Oliver Stone, who writes it and directs it. Gordon Gekko, the character played by Michael Douglas, who's some composite of Ivan Bosky and Michael Milken and a kind of sensibility, was supposed to be the villain. Right? And even though he's played with immense seductive charm by Douglas, what's fascinating is that by your class in the 90s, he's the hero.
Oh, totally.
Which was not the intended lesson in the movie. And it's very similar to the Wolf of Wall Street film with Leonardo DiCaprio that came out a bunch of years ago, where, at the end, you're kind of rooting for him. You're not rooting for the FBI agent, right?
Right. Yeah, it's fascinating how we get swept up by the stories. So I'm sure you are familiar with the work of Carlota Perez?
Yeah.
Yeah. So one of her arguments, which I'm kind of turning over in my mind, is that these capitalist manias, the bubbles, the excessive financialization, actually serve a purpose, which is that they suck productive capital into building the infrastructure on which the next wave of change, productivity, enhancement, and potentially a golden age can be built. And I think that's a very interesting argument.
Yeah. And I think part of the oscillation, particularly in American society, is that we're not good with shades of gray. We're very good with black and white. It's great, it's evil. And the story of JP Morgan, which I do a little bit in the book, but other people have written about a lot more, is like the perfect iteration of that. JP Morgan is the hero of the financial system in 1907 when he bails out the banks, and he is the villain of the financial system when he's hauled in front of Arsène Pujol's committee in 1913 to be kind of the villainous exhibit A of the money trust, the cabal that's controlling society and robbing the American heartland of its birthright to enrich and line the pockets of East Coast elites. And in a 6-year period, right, he goes from God to devil. And we do this repeatedly in our society without kind of stopping in between and realizing that, both are true. My point about Brown Brothers, by the way, in the book is they were selfish and self-serving and selfless, right? They understood that private gain and public good can't endlessly be detached, and you can't endlessly enrich yourself and beggar the commons. And that was part of their culture from the 1820s, and I think a virtuous one, even with all the vices of elitism and anti-Semitism and slavery. And I don't whitewash that. Mm-hmm. The idea that financial accumulation at a particular period of time, while it creates huge imbalances, also sets the stage for certain things, is I think both true and fascinating, right? The railroad boom in the 1870s, 80s, and 90s, almost everybody who invested in the railroads initially lost their money. The people who made the money were the people who bought the bonds at pennies after the people who invested in the first wave of railroad construction went bankrupt. Mm-hmm. Very similar to what happens in the 1890s, right? The WorldComs of the world, and it was much more about WorldCom than it was about Yahoo, meaning it was the internet bubble was a small portion of the telecom bubble. Mm-hmm. And most of the people who invested in those pipes lost their money. There was way too much capital investment in the short term, given the return short term. But if those pipes hadn't been built and those railroads hadn't been built, you don't have the 20th century industrial next stage of American power. And if those pipes hadn't been laid, pipes meaning the fiber optics, not lead pipes, the pipes of the 1990s, you don't have the internet boom of the aughts and the 2010s. There's no Apple's iPhone without the overinvestment in fiber in the 1990s. And that doesn't mean we should lionize overinvestment, a few people getting shamelessly rich on the misery of others, but nor should we demonize it, I think, to the degree that we do.
Well, one of the things Carlotta's work just makes me think about is the utility of some of that behavior. That, it's not, as you said, it's not black and white. It's these investments actually built that infrastructure. And I was working with a bunch of telecom firms right around that time, and it was one of those situations. If you were a leader in one of those firms when they were doing, say, the UMTS bidding licenses, if you were a leader in one of those firms, you were really between a rock and a hard place, because you knew in your heart of heart that this was probably going to be a money losing investment. And yet, if you didn't make the investment, your investing community would be saying, well, you're not betting on the future. You have no vision for growth. What are you doing? And so you were kind of in a damned if you do, damned if you don't situation, right, as an incumbent company. And then there was the fascinating side story. I don't know if you followed it, about this. It was a little telecom company that kept jumping in, bidding. The price would get up a little bit, then Deutsche Telekom or somebody would come in after them. They'd leave. They'd sort of see how things were going, then they'd jump in again, and then it was like a ratchet effect on the price of those licenses. You could almost see it happening over the time.
Right, they were getting the bid up.
Yep.
Taking buying and then selling when they manipulated the bid up. I mean, it was a form of market manipulation, although not one that was easily regulatorily caught.
Well, right. I mean, who institutions take a while to catch up with what's going on. So one of the things that you talked about in the book was this idea that, as you said before, that their class could not thrive unless everybody did. Do you think that we're at a moment where we're starting to, here and now, begin to have that conversation more realistically?
I don't know, right? I mean, I know on the one hand, you have the business roundtable, you have CEOs like Larry Fink of BlackRock, to some degree, Jamie Dimon in the financial world. And then, of course, CEOs like Herbert Joly of Best Buy. And there's clearly a move globally toward at least the patois of corporate responsibility and corporate citizenship, and the idea that the purpose of a corporation is not purely to enrich shareholders, that there are multiple stakeholders. I don't love the stakeholder jargon, by the way. I don't know why. I guess because it's the way it's used. But the idea that a company and a collective has a series of responsibilities that are interlinked, and that if you pursue any one of them detached from the others, you ultimately create severe societal imbalances. Look, I think that's vital. And to the degree that there were elites in American capitalism in the 19th century who kind of understood, not always consciously, what I keep jokingly refer to as the Spider-Man view of society, right? With great power comes great responsibility. Mm-hmm. And a lot of these elite institutions like Groton and these private schools in the late 1900s, and then even the elite schools like Yale et al., they were partly in the business of training the elite, and they were all young men, and they were mostly white young men, training them that they had responsibilities as elites, right? That they couldn't just be in it for themselves. They had to kind of be in it for their class, but for their country, for their society. And the turn in culture in the 60s and 70s against that elitism, mm-hmm. partly because of the effects of Vietnam, partly because of a sense it was anti-democratic and hierarchical and exclusionary, all true. Mm-hmm. It was exclusionary. It was, if not anti-democratic, it was kind of questionably democratic. The idea of the people are too dirty and unpredictable to be left to their own decisions. But the flip side, but you had an elite that believed that it had a responsibility to society, and that their actions implicated not just their own world, but the globe, in the case of the mid-20th century American elite and the power that mm-hmm. the United States had globally. And I think there's something to be learned from that, not returned to, right? Because you don't want to return to, you and I would have had no seat at those tables. And I don't think we want that world, right? If you weren't born the right gender, the right class, the right religion, the right place, thank you very much. You stay in your lane. We'll lead the world. Mm-hmm. But the responsibility factor, I'm highly critical of tech elites writ large right now. Mm-hmm. And for every generalization, there's, I'm sure, lots of legitimate exceptions, and you could point out people. But, to the degree that the tech elite in the past 10 years have gotten vastly rich, and the companies have become incredibly powerful, mm-hmm. without seeming to understand that there's a social contract there. There's a degree to which if you shape the world you're in, you have a responsibility to actually engage that world and confront the implications, even if unintended, of your business models, of your practices. And I think like the WASP elite that Brown Brothers represented, had that. That's why they went into government. It wasn't really for power per se. They had the power. It was genuinely for public service, which again was self-serving, but of service. All of the, and I wish that tech elites in Silicon Valley was much more of that mindset insofar as it recognized, hey, we should be engaging public discussions about privacy, about who gets to use whose data and for what profit, about control versus openness, about information and both wants to be free and people want to charge for it. Like that should be a conversation with government, with the public, with its constituents, all of it. And I don't see that.
Yeah, no. And I mean, in my most recent book, I spend a chapter on Facebook and its business model, and basically make the argument that if people had any clue what Facebook was gathering about them and to what purpose they would put it, there would be a revolution. But I think another really interesting phenomenon, and I'd like to come back to this conversation about the balance. But another interesting phenomenon to me is that institutions always take 25 years to catch up with reality on the ground, right? Yeah. So by the time we kind of figure out where we stand on privacy, appropriate use of third-party data, how much I can collect about you, like, is it legitimate to do this at all? By the time we figure that out, the reality will already have changed a couple of times.
Right. We pass regulatory frameworks that it's the equivalent of fighting the last war. Yeah. Right? We're in a constant state of like a Maginot Line. We're always trying to protect against the abuses of the past, and by the time that we do at a government or regulatory level, the abuses of the present and the future have already made manifest.
Well, there was I think one of the co-founders of what's the company, 37C Basecamp, who made an observation. He said, "Look, if you want to fix the data problem, just make it illegal to capture this data and to preserve it." It's simple enough, although it seems sort of inconceivable. But quite seriously, there's a lot of discussion that this thing is just spun out of control, and we have no way of getting the genie back in the box. On the one hand, on the other hand, there's serious social harm being done, and we're not somehow having that conversation.
Or pay people for their data. I mean, I think that micropayment idea that Jaron Lanier talked about years ago, even though it wouldn't amount to much in terms of actual payment, like my data, your data is close to worthless.
Yep. No, it's
that it's only worth something in aggregate, but it's worth something. And even the payment of it in a de minimis level, I mean, this is a whole other conversation, I think could change the social contract. Even if it's not a material change to any one of us, if you got a check for $8 a month, but it would change. But it would be a high level signaler of our data is actually being used for someone else's profit, and we deserve a share, maybe a very small share.
I'm philosophically very much aligned around that. So you said earlier that you didn't think that you were still on the fence as to whether these conversations were going to be more real. And I'm reminded of, I guess, at the end of World War II, several threads that kind of come together. So the first thing that I'm fascinated by, and in the book you talk about it as well, is how FDR managed to keep the ruling class in charge, even as they vilified him for passing some of this really pretty dramatic social legislation. But, it was a way of keeping the reins of power in the hands of those who had already had it. But then after the end of the war, a bunch of business leaders got together. I think it was called the Council for Economic Development. And they said, our primary job right now is to create jobs, because we have literally tens of millions of people who've been trained to kill people back in the country without anything to do, right? And then this group of corporate leaders basically agreed that they would make less in profits, try to create a middle class, try to really encourage job creation. And I'm not sure that conversation is one that we're having at the moment.
No, and that, I think, once you've detached the elite and their money and their privilege from the common good. It's, it's hard to put that genie back in the bottle too. Although I do think we are endlessly in the process of remaking our culture, or making the culture of the future, right? The future is an unwritten book or an unwoven tapestry, and we are all in our ways part of the weaving of that. And I don't think any of it is a given going forward, right? None of the structures we have are like laws of nature structures. They're just human systems that we've created at a moment in time for a purpose that can evolve and change, right? And I know that can sound hopelessly idealistic in a cynical world, but I believe it, and I'm going to keep saying it. And occasionally I have platforms to do so. So, I do think we can evolve and change. We are capable of doing so. We have done so in the past. You're right that conversation isn't existing, and I think it's not existing because too many of our people of privilege and institutions of privilege have talked themselves into a belief that there was a hilarious line that Tom Lehrer had about Werner von Braun, who was the Nazi missile scientist who came over and helped develop the U.S. missile program, and he joked, "Wenn they go up, I don't care where they go down. That's not my department," says Werner von Braun. The idea of, hey, whatever the social imbalances of my profit and my success individually or corporately, I'm not responsible for infrastructure and roads, and that's a Milton Friedman kind of narrow definition of what a company is about. I see a lot of individual change in that, and I see a lot of absence of individual change in that. There's certainly nothing comparable to what happened in World War II, where in fact, American elites also believed that because they perceived there to be an existential threat of communism, that unless the world around thrived, unless Europe thrived, and other parts of the world, that the American system would be imperiled, and therefore they would be too. So they spent a lot of money. The Marshall Plan and aid to Europe was not altruistic, right? It wasn't like, it was pretty much, we have to spend money to create markets, or a vacuum will be created, and then communism will come in, and then we won't have markets. But it was still an understanding that there is a larger context here that we are both individually and collectively responsible for.
Well, one of the things that we see now is, as we look at the conversations about things like structural racism, how many of these structures, if you're not subject to them, you don't actually realize how pervasive they are. And that's something I've been thinking about quite a bit, which is, if you start here and I start there, it's going to be pretty hard for me to catch up, right? And I think that's a very interesting conversation, which I hope we are going to have more of, because I think that's another situation which hurts everybody, right?
Yeah, and look, I've been very clear. I've just written a long book that is unabashedly a history of rich white men in America, all of which are deeply exclusionary categories from a high place of privilege. What I do think is important about that group of privileged people is, they were born on third base. Obviously not the founder, who was an immigrant. Alexander Brown comes from Belfast in 1800.
I was fascinated by that. My husband grew up not too far from Belfast.
Right, and that was Irish linen was the big big export of Ireland at the time. But subsequent generations, they were born on third base, but they didn't think they'd hit a triple, right? They knew they were born on third base. They were told, you were born on third base, dude, and you have a responsibility because of it. That's a crucial differential. There's always going to be people of privilege, and there's always going to be positions of power. The question is, what do those who are in it do with it? Do they believe, a la Donald Trump, that they were self-made and they have no responsibilities to anyone except themselves, and some notion of, the collective that's highly selective? Or do they believe that, back to that, the great power, great responsibility equation?
So one of the things that intrigues me, and this is related to the book, when the financial firms went from being partnerships, right, where as a partnership, a lot of your net worth was tied up in the value of the partnership. And when you retired is when you got your big payout, right? And so your incentives were very much about, I'm not going to take short-term make short-term decisions that are highly likely to blow the place up at some stage, I'm going to be very mindful of the balance between today and tomorrow, I guess is the way I would frame that. And as these financial firms became publicly traded, as the shareholders were willing to pump money into them, and it wasn't the partner's own personal capital that was at risk, it really changed the mindset. And you could feel it happening, right? I mean, when I was growing up, banking was boring. like the A-level people did not go into banking. Like the brightest, best minds at graduate school did not go into banking. It was sort of, you made your margin and you got a little bit above what the regulators would allow, but it wasn't seen as this super sexy Wall Street kind of place where, you could do all this financial engineering and come out on top. And then, we continue to have these crashes. So the crash of 87 was a big one. Then we had one, a few years ago, 2008. And I just wonder, is there some way we can get people thinking more about what are the ways we need to build resilience into the system, that kind of push them to think more about what could be the downsides down the road?
Like, I think part of it is, we do have to confront the structural limitations of publicly traded entities of scale. And part of those are the way in which that has evolved in the past 30 to 40 years means that gains are likely private and risks are put on the public balance sheet, whether that's public shareholders or actually the government itself. Mm-hmm. And obviously 2008, 2009 with companies like AIG in particular showed that, the ultimate risk falls on the government balance sheet, because if you're systemically too big to fail, that is a problem of the structure, right? A Brown Brothers Harriman and a Brown Brothers partner in 1880, when confronted with a railroad investment, was aware of every dollar they put into that was a dollar that they could personally lose. Mm-hmm. You put up $1 million, you might personally lose $1 million because mm-hmm. you're a partnership. It's your money.
Exactly.
And even if you create a consortium, and all these were consortiums, right? So nobody was fully exposed to anything. Even so is your money. In today's world, I'll just use Tim Cook as an example, not as a negative person, just as an example. Apple could do a big deal. They could buy a supply chain company because they don't want to keep outsourcing it. Tim Cook could potentially make $10 million personally on that deal. Mm-hmm. There's no deal that Tim Cook is going to lose $10 million personally. I mean, mm-hmm. unless it's a catastrophically bad deal and Apple stock, craters by X%. That 10 million loss is going to be disseminated amongst shareholders and bondholders and banks and Apple and stock, all of it. Same is true of a private equity fund today, mm-hmm. right? Apollo Management's never going to have the people who run it are not going to personally lose the money that they personally stand to gain. They're not even a public company, but they, institutional investing and lots of people that they are investing other people's money, right? Mm-hmm. So what do you do about an incentive structure that allows that? How do you change that, right? And I'm not hugely in favor of a punitive regulatory framework, because I don't think punitive regulatory frameworks change culture. They may change incentives, but they don't change culture. And usually if you haven't changed the culture, the negative regulatory incentives lead to kind of even more perverse culture that tries to either avoid
Sarbanes-Oxley. Right.
So, wealth of good intentions, lots of unintended consequences. So, I have to confess that other than trying to do my part of putting out a series of messages that people may hear that they may inculcate within their own organizations, I don't have the perfect silver bullet answer to these incentive structures. Mm-hmm.
Mm-hmm. Well, capitalism doesn't, as a general rule. I was talking to Rebecca Henderson. You may know her book, Reimagining Capitalism in a World on Fire. It's a terrific book. If you haven't read it,
I just, funny enough, I just bought it last week. So.
Did you really? Yeah, it's great. It's a great book. And I
bought it last week because in a narcissistic sense, it showed up when I was looking at my own book as books you may like. And I'm always interested in what affinity algorithm I end up being a part of. So if you go to Amazon and you look up Inside Money, her book showed up and I'm like, oh, I'd heard about this. And then I clicked it on and then I looked at it and then I got it. Yes. So, I was driven to her book purely through the narcissism of looking at my own book.
That's wonderful. I'll be sure to tell her that. She'll be pleased. Anyway, she makes the point that capitalism is fairly bad at independently pricing goods under various scenarios. So when the benefit, as you've just pointed out, excessively accrues to one party and the cost is really diffused, it's really hard for capitalist systems to sort that out. Similarly, if the cost is really, really borne only by a very, very limited group of people, disadvantaged people or people who are being discriminated against by race or whatever it is, and the broad majority benefit a little or don't really notice. Again, capitalism really struggles with properly pricing those things. And her I guess her thesis is that there are ways we can actually begin to reimagine that, and ways we can bring about social change, by one step at a time, kind of changing cultures. And I think she used as an example the Clean Air Act, that rivals managed to put their rivalries aside for the benefit of something that no one person benefited from, but as a society, we all benefited enormously.
Yeah, I'm sure, there are lots of interesting ideas out there about, back to the versions of paying individuals for their data because other people are profiting from it. I mean, you could certainly within a company socialize gains a little more within a capitalist system, and not stratify them to the degree that they often are. And again, there are some particularly private companies that do this, right? Because they're not answerable to a certain demand of public investors about how profits are utilized, right? And there are some indications of this changing, right? I mean, Walmart has been progressively raising wages for its employees more rapidly and independent of either a federal minimum wage raise or states. Again, this is partly self-interested. One, it forestalls bad PR, it forestalls legislation. It also turns the 1.5 million workers, or however many number it is right now at Walmart, maybe it's closer to 2 million, into viable customers, right? If you don't pay your own workers of that scale enough money to actually shop at your stores, you have denied yourself a massive, almost embedded customer base, right? So there is a real self-interest in paying your own workers at a place like Walmart more because they then become your customers, which is not quite the same at other firms, right? You don't have the same dynamic at Honeywell, right? No Honeywell worker is going to buy an engine, or
an aircraft brake shoe.
Right. But the idea, it's a similar principle of there's lots of reasons to not do what so many companies do in pooling all the rewards at the top. And look, I mean, companies have found with visionary or at least strong-willed corporate leaders that if you essentially tell Wall Street and Wall Street analysts to go, right? Like, no, I'm going to raise wages. I don't care if that cuts into my quarterly earnings because it's good for my business, or I'm going to reinvest in the business. I don't care if that depresses my Q3 forecast. This is what's going to build long-term value. The fact is, Wall Street will ultimately follow that lead.
Oh yeah. We actually have a metric that we use. It's called the imagination premium. And basically, it's a way of breaking down a company's market cap into what investors expect from you just because you're throwing off so much cash, the value of operations, and the value of growth, which is, you can work out how much is due by having out from operations. And if you're worth more than that gives you this imagination premium. And what we've found is very, very high imagination premium firms basically have everything priced to perfection. But if you can deliver, right, you're fine. So like Amazon, I think their imagination premium is like 4. I mean, in other words, like a quarter of the company's value actually comes from the cash flow it generates from operations. Everything else is for growth. Now, if you're low, if your imagination premium is too low, and this is where I really get intrigued at these CEOs talking about, the short term. If you have a low imagination premium, you are highly likely to attract an activist. You are highly likely to be, get a hostile acquisition attempt. Your CEO is highly likely to be shown the door. So we've actually got some research that shows that it's highly correlated with what happens to that leadership team. So one of my hopes is that and metrics like it can start to be something that we build into the mix more, so that a board could say to someone, hey, why, Wall Street's not buying your growth story, right? Let's talk about that. But I think unless that kind of pressure starts being put on leadership, you do have this, you keep the wheels turning, how's the quarter going to work out kind of mindset.
Of course, then you have the Brown Brothers Harriman conundrum, which is they probably have a very low imagination premium in their business, very high cash flow premium.
Mhm.
But they have a culture, back to what I said of that partner in the 1980s, saying we're not going to scale our business to meet demand. We're going to curtail demand to meet our business.
Mhm.
Um, part of my point in the book, both directly and indirectly, is you don't want a system composed of only one culture, right? So, like Brown Brothers as a firm would never have invested in Amazon or Elon Musk. And they're not even an investment firm in the traditional way now. They're much more of a commercial bank and a wealth manager. But the point being, risk capital at that level just wouldn't have been their culture. And I think part of the point is you want a system composed of a variety of temperaments, right? You don't want everybody bullish. You don't want everybody bearish. You don't want everybody going for the gold ring and 100x return, but you don't want no one doing that. And part of what I say in the book, and I've said in interviews, is the ratio of risk capital to stable system capital has gotten way too skewed in the past 30 years, where far too many people are jumping in the risk end of the pool and not enough people are jumping in the risk management end of the pool.
Mhm.
But you don't want everybody in one end,
Right.
right? It's not like, I think a world composed only of a Brown Brothers mentality would be too static.
Mhm.
It would be not innovative enough.
Well, that's one of the claims that gets made for a lot of European countries, right? That their leadership and their business cultures, I'll just pick on France as an example, are so too much in the stable side of things that they don't have the dynamism that a faster growth economy might.
And that's a totally legit criticism. I just think the balance has gotten way skewed within American, particularly financial capital, but it's also true in the large publicly traded companies. It's true it's true in a lot of areas of the American economic ecosystem. And I think it's the ratio issue, right? You want risk to be a smaller portion of your overall system than the predominant portion. And I know you've taught this for years. It's making people mindful of the fact that money is power. But as power, it has the power to destroy just as much as it has the power to create, a la Schumpeter, right? And those at the epicenter of money in particular, the distributors of, the conduits for, should be mindful of the quicksilver nature of what they have at their disposal. It's like you don't want your nuclear scientists to be promiscuous about using it. Right? You want them to be mindful of using it. And I feel the same way about money in our system.
So let's talk a little bit, got a few minutes left, on about the Progress Network, the New America Foundation, because you're putting time into that, and then the fellowship at the Foundation for Research on Equal Opportunity. Yeah, I'd be just interested in hearing what some of those organizations are, what are their goals?
The Progress Network I created at the heart of the pandemic. I had meant to launch it before the pandemic, but ended up launching it at the very end of 2020, so less than a year, of which you are now a proud member of nearly 100 people. And the idea was, we live in a world where there's a cacophony of bad news and a kind of a generalized conviction that the world tomorrow is going to be worse than the world today. And certainly a pandemic world combined with a, post-financial crisis world combined with a, globally weird world has not done anything for most people's enthusiasm about the present or the future, particularly in the developed world. Optimism and sensibility about the future differs greatly by country. Places like Asia and China tend to be more optimistic about their future because they've been in a rising curve. Places like Western Europe, the United States, Latin America, to some degree, have tended to be much more pessimistic, partly because we've crested in our growth profile, partly because we're so affluent. It's partly a product of success. Anyway, the point being, we live in a world where there's just a cacophony of bad news and a media culture that uses bad news as a way of attracting attention, because that's just human nature. I'm not really demonizing the media in that. But there's a lot of people who are talking about how we solve problems we have, or that things are not, the optic of things being as negative as we think is a distorted one. That there's a lot of good going on. There's a lot of change. There's a lot of progress. But we don't tend to pay attention to it for the reasons I just said. And I feel like we have a real, both an optimism deficit and a pessimism imbalance in our public narrative. And that there's a lot of people who are individually offsetting that narrative, but because they're individual and they're not a collective, they're always less than the sum of their parts. So a lot of people who are part of the Progress Network, like you, or Fareed Zakaria, or Tom Friedman, or Anne Marie Slaughter, or Steven Pinker, or David Brooks, Bina Ventikaram, there's a whole slew of people of multiple races, genders, ethnicities who are prominent in their worlds, but are atomized in a culture where the dominant narrative is we're screwed. And that if you could bring them together and create some network and create a real network effect, you'd create more critical mass that would help us latch on to, we might have problems, but we're solving them, and we might have solved more problems than we pay attention to. And partly from the belief, not that I'm Pollyannish about any of this, that if things are going to hell in a handbasket, it will not be for lack of multiple voices saying that we are, warning about it, highlighting it.
Mm-hmm.
Right? That waterfront is well covered. The we're screwed waterfront is well represented. But what, the central question I'm asking with the Progress Network is what could go right?
Mm-hmm.
We spent a lot of time looking at what could go wrong.
I love that. I love that. What could go right?
Launching a podcast next week, by the way, for those interested. First 12 episodes will drop over the next, 10 weeks.
Fantastic.
And that's why I did it. So it's 100 people so far, but it's also a newsletter that sort of highlights interesting but underexamined stories. Not good news. This is not like feel good. Firemen rescued cats and trees. It's what are people doing to solve viable problems? What are those problems? And what is the world going to look like?
Mm-hmm.
It's a Twitter feed that we highlight stuff daily, and it's members like you trying to be a megaphone. It's a nonprofit. So the point is, this is in service of those voices, and that ideas matter. I said earlier, culture matters. I think ideas matter.
I do too.
And the idea climate in which we exist is as important as the physical climate and the global, literal climate change climate that we exist. So this is like an idea climate change network.
I love that.
Idea climate for the better.
Yeah, and one of my previous guests was David Borenstein,
who's also a member of the program.
Yeah, great, fantastic. And he's written the Fixes column for a long time in the New York Times, and kind of building on an idea that I don't know if it was their idea, but they certainly popularized it. Chip and Dan Heath, talking about if you want to solve thorny social problems, go find the bright spots.
Right.
Don't just look at where things are all screwed up. Find out where people have actually come up with solutions, and then see if those can be scaled and replicated. I think it's just marvelous. That's just great.
Well,
so what could go right? I love that. That's a great question.
And that's what we call the newsletter. It's what we're calling the podcast. It's something I kind of noodled around with for a while. For about 4 years, I wrote a column for Reuters and The Atlantic called the Edgy Optimist. And the point was not to be, oh my God, things are great. The edgy part, meaning striving for some degree of realistic optimism.
Yeah, Tim Harford, who does a lot of work trying to make data more digestible for people, made an interesting observation. He said, yesterday, 150,000 people were raised out of poverty. He said, that's very important, but it's not news.
Right. Right. And that is, there is no such thing as good news in the sense of the news industry. Because good news doesn't sell. And that's always been true. It was true for yellow journalism and Pulitzer papers in the 1890s, and it's true even more. The irony of the internet being driven by the immediacy of eyeballs is it's actually made that issue substantially worse.
Yes, it has.
Even as there is a proliferation of channels for ideas, it's never been easier to get your ideas out there into the ether, although it's much harder to actually get attention because there's so much, right?
Right.
200 million videos on YouTube. Trying to get someone to watch yours is a challenge. Right. But it's much easier when you're on the soapbox, right? My question has been, can you get on a soapbox and declaim with urgency, everybody calm down? Or are you just going to be like the Kevin Bacon character in Animal House, who does that and they get stampeded?
Well, I guess we'll learn, right? So where do people go to learn more?
So you can go to www.theprogressnetwork.org or look up the Progress Network on Twitter or LinkedIn, or we're actually have an Instagram, like we do a daily dose of progress on Instagram.
Oh, wow.
Pointing out
That's fun.
Data, literal data, not opinion. And then, and sign up for the newsletter.
Awesome. Oh, that's great. Well, it is so nice to reconnect with you, and we should not let it be so long in between conversations going forward.
I was going to say, there's actually a fireplace much like yours right next to me, but I couldn't get it in the Zoom frame. But I thought it would be very funny if we could have had a fireplace chat.
Fireplace. Absolutely.
It's there. I promise. It's right there. Not
right.
all.
Well, thank you. Thank you so much. And I'm definitely part of the network, and I'll be looking forward to see what we can pull off in the months and years to come.